recording. All right. So, I know it might already be like old news to everybody, but I just need to continue to stress the calendar. This calendar has been available since the beginning of the semester. It was there when I first contacted you to welcome you to the class, sometime in, the teens of September, or the 9th of September. I can't even remember, before the 9th of September. But the point here is that, today we discussed this last week, and I'll say it again today at 6 o'clock. Your chapter 8 homework is due. This has been the case since the start of the semester. I see that all but 3 people in the class have already either completed or are in progress. So those 3 people who have not yet started the homework, please make your way over to connect and get going. You don't want to leave this homework till the last minute. There are some tricky things in there that you want to make sure that you have a holdover before 6 o'clock comes. I mean, by the time we finish our class, it will already be almost 1 o'clock, so you won't have that much time left to do it. And I'm sure you have other requirements on your time, so please make sure to get with that. I sent you guys, I don't know if it was hopefully a helpful email on when was it, on Wednesday, but it may have been a little bit cryptic, so I just want to show you in the homework, in question 6, for whatever reason, and I think it was Marina who pointed this out to me. In question 6, where you're doing dollar value LIFO, for some reason, if you don't have the division sign on this third column over here, the system was marking her stuff wrong and was taking off 0.25 off of her score. And for whatever reason, even when she fixed it, the points didn't come back. So please, if you haven't done this question yet, just use a divide sign. This is for when, when we're going over dollar value LIFO, and I was saying that when you are restating the inventory at the current year's cost to the base year cost, right, to get it to the base year, you can either multiply by 100 over, let's say, 105, or you divide by 1.05. If you look in the textbook, you also see they divide by 1.0. It's the same thing, okay, because 100 over 105 is multiplying by 100 over 105 is the same as dividing by 1.05. But because the solution is forcing you into these cells, you need to make sure that you're actually using the 1.05 or 1.15 or 1.2 or whatever it is, that the indices that you are given, so that you are doing this the correct way, all right? And they're over here, they're telling you what the amount is at the base year cost. So it's basically that you're backing into the 1.05. If someone is stuck with this or doesn't know what I'm talking about, I'm happy to stay on a little bit at the end to walk you through this. All right, they're basically giving you this answer, and they're giving you this number, and they're just saying, what does the number in the middle need to be in order to get from year to year? And it's kind of the same approach. I mean, you're basically just solving an equation. It's the same as if I gave you these 2 numbers and you had to get this answer, right? It's just kind of solving for X, or, I don't want to make it sound harder than it is. So again, if you're having a problem there or something, I can stick around at the end and help you. But this, just to remind you, this homework does count 3% of your overall grade for the class, and it is unlimited. It's unlimited attempts. So, there's a very loud noise, although I have a software that removes the noise, but sometimes when a loud noise comes through, it's distracting to me. So it's 3% of your grade. It's unlimited attempts. There shouldn't be points deducted from your grade at all. If there's some issue with the system deducting points, just contact me. I can manually adjust your grade. I had to do that for Marina. I had to go in and manually adjust her grade because the system was acting up. All right. So that's today's work. In terms of homework, we'll still continue with chapter 9 today. We're gonna probably get through most of it today. And then what will happen on Wednesday is that I will go over the chapter 8 homework that was due today. I will review on Wednesday to make sure that everybody review with you. I mean, on Wednesday fairly quickly, but in some detail to make sure that everybody understood what happened and had all their questions answered, because remember 8 and 9 are on the first test and quiz. So there may be questions that you still have even if you got the homework correct 100% or whatever. You may still have some lingering questions. So on Wednesday we'll go over that chapter 8 homework and finish off anything that we need to for chapter 9. If we're done with chapter 9 already, we'll move on to chapter 10. Marina was just asking me about the term paper optional. Please, again, it's optional draft submission. You don't have to do this. There's no pressure to submit it. I just do this. It's almost like, I guess, to some extent, a courtesy that I do for you, because sometimes people feel like they're not sure if they're answering the questions, the way it's expected. So they feel a little bit insecure. So if I can read what you've written and I can give you pointers that can help potentially to improve the grade that you may get on the paper. And so this coming Sunday is when that optional draft is due. I'm so sorry, excuse me. I'm not accepting drafts all throughout the semester. It's you either submit your draft A on the 10th, or you just then don't submit a draft. You can skip submitting a draft for A and submit a draft for B. It's not dependent, right? You can submit a draft for A and not for B, depending on your schedule. It's fine, but please don't write me on the 10th and say, I'm not done yet. Can I please give this to you on the 13th or the 20th or whatever. The whole point of me making this date so making the date the 10th is that I can have some time to read your work and give it back to you, so that you can then move on to the next part of the paper, and I can read and give it back to you, so that those who do want to do an early submission of the paper for 5 bonus points will be able to do it, in time. So think about that. Again, it's not a must. You don't have to submit this draft. We're at October 4th. You have 6 days. You can decide what you want to do, and that's also due at 6 o'clock. So, if you can't remember anything, like what were you supposed to write about, or what were you submitting? Remember, everybody already selected a company to write about. A few people, a lot of people were interested in Apple and Netflix and so on. That's fine, guys. I just want to be clear. I know some of you are friends. You probably know each other. You work together. You like to study together. Under no circumstances should people be copying from each other or writing the same stuff, or doing anything that even vaguely resembles plagiarism. You will get a 0 on the paper. It's not acceptable. So please make sure that you're doing your own work. Also, please make sure that you're not just copying and pasting things from the internet and then putting a reference. If you find something that's really helpful to you, you can paraphrase it. And yeah, I mean, I'm not talking about like, Netflix was started by person ABC in whatever state. And I mean, those are facts, right, that are going to be the same for everybody. I'm talking about just some of the other ways in which things may be written about what the company is doing, or, just if you're unsure, like, speak to me. But as soon as you're going onto a website and, going into, just copying things over, you have to be very careful. There needs to be paraphrasing, even if you cite your source, right? Even if you say Andrea Francis 2021, you can't, unless it's in quotation marks and it's a very short part of what I'm saying in quotation marks, you can't just bring over, you know, a whole paragraph of something I'm saying and put the citation at the end, because then you're not actually writing, right? Somebody else is writing and you're just putting pieces of other people's writing as your own, which doesn't show me that you've actually thought about this and written it up. You can write in your own voice. What I mean by that is it's not like a formal paper where you have to be so stodgy that it sounds, you know, like someone else other than you. So, you know, I'm not talking about using obviously like slang or things like that. That's not what I mean. I'm just saying that you're writing to me, you're writing in your own voice, you're writing about a company that you're interested in. It doesn't, you don't overthink, you know, the language too much. I know that some people are non-native English speakers, and even just the concept of writing something is very daunting. I get it. This is, you know, part of learning together, and this is also why I'm saying that you can submit a draft. If you let's just say, right, you want to submit a draft, but you only did, like, because this is going to come up, I know already, you only did the first three, you've only answered the first three parts, you haven't answered part four, that's fine. Just submit whatever you have up to that point and just write a note for me in the email when you send me the submission to say, Professor, I've done, you know, parts 1, 2, and 3. I'm still working on 4. No problem. Will I be able to look at 4 at some later stage? Probably not. Okay, because there's so many other things that are happening in the class. So let's not assume that I'll be able to look at this, but I will look at whatever you send me because I want you to feel, you know, confident that you're on the right track. Something that I also say about references and citation, I think it's written at the bottom over here in the document, but please don't use Wikipedia. You guys know this already, so obviously, you know, I I don't have to say this, but it bears, I guess it just bears a quick note. Wikipedia and blogs, like if you go to someone's blog or someone's website or whatever, that isn't, you know, a vetted, recognized website, that's like stopping someone on the street and saying, hey, what do you think about Netflix or whatever. You need to make sure that you're actually using proper references. And you know, Wikipedia can be updated by almost anybody. So you know, you if you go to Wikipedia and read something about a company, your best bet is to look at the references at the end of the article, and those are primary sources, okay, that you can potentially use. But using blogs and things or just Wikipedia in general is not your best option. And then, you know, make sure that I know you're sending me a draft that I read to help you, but please make sure that you actually proofread your own work. You know, make sure that you cast your eye and sometimes it even helps to read some of it out loud to see if it makes sense. I've often had to like send stuff back to people to say that, you know, it's difficult to follow what you're telling me because there's, you know, there are uh, grammatical or whatever errors that are are you know, making the understanding a little bit difficult. You can use things like grammarly.com and other, I mean, you guys are so savvy with the web. There are other ways to get your work edited so that it's a little bit that it's flowing a little bit more readily. And the other thing that I'll say as you write, please make sure that you're using the most recent annual report, which is also referred to as a Form 10K, the most recent annual, okay, for the whole year, annual report. Why am I being so, you know, crazy about this? Because I'm going to be pulling, right? No one has to feel sorry for me. It's fine. I did this to myself, but I basically have to pull 6 annual reports that I will use to check people's work, right, for accuracy. If you use a quarterly report or you don't use the most recent annual report, and I can't I can't say that that annual report is 2021. It might be 2020, depending on when the company's year end is. But you can easily go to the company's website to their investor relations section, and you'll be able to see the most recent annual report or Form 10K, or you can go to sec.gov. I think I even listed that over here. If you go to this company search, that will also show you the most recent annual report, or the company's website, same thing. It will show you what it is. And that's because, again, it makes life orders of magnitude harder for all of us if you work off of a quarterly report or some old annual report, and I'm looking at what you're writing about financial highlights, and I'm comparing it to what I'm looking at with the company's most recent report, and the numbers are not the same. I'll have to send it back to you and say these numbers are not what I asked for, right? Think about it. If you were at your job and your boss says to you, write me a memo or report on our most recent, results. It's going to be a big problem if you're using last year instead of the current year or whatever. So please make sure that you're using the right information. And this is especially important for people who are not planning to submit drafts, because if you don't submit drafts, but you're actually using the wrong annual report, points will be deducted. Okay. And so if you're unclear about whether this is in fact the most recent annual report, again, you can ask me, or just go to the company's website and see what's there. It takes the auditors like something like up to 3 months to audit the financial statements. So companies that have a December 31 year end will issue their financial statements, their annual report on March 31st of the following year, or in that time frame of the next year, within the first 3 months of the next year. So if you know that you have a company with a December 31 year end, that means that the most recent annual report would be December 31, 2020, and you would be looking for a 10K that was issued sometime between January and March of 2021. So that's what that means. Does anybody have questions? I'm talking a lot. I'm not trying to overwhelm you. I'm trying to help you, and this may not even be as helpful as I think. So ask me.
Professor,
Sharon, yeah.
can I use reference 2018 in
2018 what?
time newspaper?
Oh, you mean, sorry, can you lower my voice? Because it's,
Yeah, can
okay.
I use reference in newspaper reference 2018?
Yeah, if it's something significant that happened in 2018, absolutely. Yeah.
Okay.
I just mean, don't use the financial statements from 2018 right? You understand what I mean?
Yes.
Okay. What else? Any other questions? All right. So the last thing that I'll say here is, for this financial highlights piece, I found that the people where it went a little bit better with this thing is when they made a table. People who made a table and wrote, years, revenue, expenses, assets, liabilities, stockholders' equity, maybe the cash flow, cash flow from operating activities or whatever, and did the current year and the previous year, which you'll find in the same financial statements. The companies have to show comparative financials. That was the easiest for the students to be able to see the numbers and see whether the company is improving, or it's getting worse, or whatever the case may be. So you know when you do this, you may be tempted to just write out in a paragraph, oh, assets went up from, $10 to $20 and so on. But even for yourself, it might become difficult to follow all the different movements in the numbers if you write it out as a paragraph. Whereas if you make a table, and like I said, I'll accept a table, feel free to use a table. You can actually see, you can do, let's say 2021, 2020, and then the increase or decrease, and then that will help you more easily be able to see, is the business stable? Is it improving? Is it deteriorating? Right? So think about that also when you're planning how to present the information. This is all, again, things that you will probably be called upon to do if you haven't already in your career over time. When I was working at Deloitte, we had to look at this, the financials of our clients that we were working on, and write up all kinds of work papers and stuff about changes in the numbers, and then also do the testing to make sure that the numbers were actually, I'll say correct in quotes, because you can't say that everything's correct, that they were not materially misstated. And I just spoke about this now. Why do we audit a company? Because we want to make sure that the numbers are not materially misstated. I'll look in the break, maybe I'll look for a form 10K for a company, and I'll show you what they write in the audit report, so you can have an idea of how the auditors phrase what they're doing and why they're doing what they're doing. Remember, the auditors are appointed by the shareholders to basically check the numbers on their behalf. Okay, so that's the story with the term paper. Any other questions around that? Anybody want to raise a point about that? I think this was just a good morning message. Okay, so there's nothing there. All right, so you decide, right? If you want to submit via email to me, submit a draft or not. And then the other thing, which is more like a school admin thing, is on Thursday is now like the new deadline to submit your vaccination. I shared this with you guys before, that CUNY Central extended the deadline for schools that are on a 12/6 semester, which we are on. So October the 7th is the new deadline to submit papers if you are in classes that actually are marked as in-person or hybrid. If you do not submit, I mean, I've said this before, but I'll say it again. If you do not submit your vaccination records, by this deadline, and they, review the records and find that you are not in compliance with submitting the documentation, you will be administratively withdrawn from that course. So if you look at this doesn't apply to our class, but if you look at your other classes, if any of them are in person or hybrid, you have to do that by Thursday. All right. That's that. And then I also just wanted to point out to you, you guys probably know this already, I don't know, but on the website, there's something called campus updates. So if you're not maybe following your email as much as you could or should, there are like things on the website here that show, and I mean, this is going back very far, but things like this at the end of September and so on, they have replicated information that they did share to students on this campus update thing, in case you're concerned. And then there's also frequently asked questions section for students. If you're coming to campus, what is going on? How do you get there? How do you reserve study space if you maybe want to go and study on campus? How can you get a laptop or other resources, etc., etc. Okay, so hopefully, I mean, my hope is that this thing is being updated, and I think it is, because it's talking about the October 7th deadline as well. The instructions are there to submit your vaccination information, and I spoke about the New York State Excelsior Pass before, that if you have that, probably will make your life a little bit easier in terms of getting your information up to date for the school. All right. So just again, it's one thing that we're like, oh, we're continuing with accounting, we're doing all this work, and that's great. But I feel like I also have a responsibility to you guys to make sure that that you are able to stay in your classes and graduate and so on. And part of that is, these mandates that are coming down from the top. We have to make sure that they've been communicated to all of the students. Any other admin type questions, anything that you want me to speak to before we go back into chapter 9? All right, it looks like everybody's okay. Right, so going back in here to inventory estimation techniques. So again, we're back in chapter 9, which is about subsequent measurement of inventory. After you've done all the cost flow assumptions, you've done the initial measurement of inventory. We now saw last week that there are ways in which we have to look at inventory after, or assess, I guess, the inventory after we've done the cost flow assumptions and other calculations, to make sure that there isn't a disparity between cost and either net realizable value or market value, to the extent that market value or market and net realizable value are lower than cost. Because if that's the case, right, remember we went through all those examples, if that's the case, then we have to write the inventory down. And we said we could write it down using either the cost of goods sold account or the loss on inventory write-down account. I believe there's an ethical dilemma in your textbook near the front of this chapter, talking about, the choice between cost of goods sold or loss on inventory write-down. And we spoke about that a little bit, that, loss on inventory write-down very obviously shows a user of the financial statements that the inventory was written down. And sometimes companies don't want to draw attention to something like that, because inventory is a source of revenue. And if they're showing a material, meaning a large, write down in their inventory, investors may begin to question why the inventory is being written down, right? Is there less demand for the product? Are they not buying the right products? Is inventory obsolete, and so on? So companies sometimes opt to go with cost of goods sold as the place to debit, because they know that cost of goods sold is kind of a big number on the income statement, not necessarily going to attract as much attention as this, other, we have the non-operating or other losses and gains, and that's where this would go, and it would have its own separate line. So it's up to the company what they do, and that's what that ethical dilemma is about, right? Do you put the number into a line item that is obvious, or do you just hide it in cost of goods sold? And then you've got a low of cost or market, which we spoke about. This is used specifically for LIFO, and we said that you compare historical costs to these to market, and market is replacement cost, but it can't be higher than the ceiling, which is net realizable value, and it can't be lower than the floor, which is net realizable value less a normal markup. And you guys were pretty spot on with your calculations of this. And remember, if you compare historical cost and market is in fact lower than cost. In fact, we have it over here in our calculations from before. For the most part, there's no journal entry, which is what you expect, because you expect to be able to sell the inventory in the market for more than what you paid for it, right? More than the cost. But sometimes, right, the market is in fact lower than the cost, at which point you need a journal entry. And then that journal entry is, what we spoke about. You can either choose to use cost of goods sold or loss on inventory write down, and the amount of the journal entry is the difference between historical cost and market, or historical cost and net realizable value. And I also gave you and this is all from before, it's just a brief review before we get into gross profit method. I also gave you this kind of tip or trick or whatever to say that, market is replacement cost, and we know there's a ceiling and a floor. Once you've calculated all three numbers, right, the market number is always the middle dollar amount. When you look at the numbers, whether it be from highest to lowest or lowest to highest, it's always the number in the middle. So if you can't remember the theory behind why market is the number that you should that you're choosing, at least you can have the shortcut to remember that it's always the middle number. All right. So that was the first part of this chapter. And then we spoke about a little bit about inventory estimation techniques. So that's these are techniques that are used at in interim periods, which is quarters. So, if a company has a December 31 year end, they're going to issue interim financial statements every 3 months. So it will be March 31st, it will be June 30th, it will be September 30th, and then on December the 31st, they issue the annual financial statements, right, for the whole year. So in interim periods, companies don't do physical counts of inventory because it takes too long, and also because they're not required to have the financials at that level of accuracy. So they're allowed to use estimation techniques. In fact, when I used to audit at Deloitte, when we audited interim periods, it was actually not a full audit. It was just a review of the numbers because, again, we weren't doing all the steps that you would normally do at the end of the year. So similarly, companies are also able to do certain estimations and things so that they can kind of save time and not spend too much time on things that are going to be done at the end of the year anyway. So the two estimation techniques that we will focus on are gross profit method and retail inventory method, and they're calculated in somewhat different ways, but both of them rely on looking at the relationship between sales and cost of goods sold. All right, so in some way, remember, you're trying to estimate an ending inventory number that's going to go onto the balance sheet. That's the whole point of the estimation technique, right? But depending on how you are updating your records, you may also have to use some type of estimation for what cost of goods sold is to get to ending inventory. And that's what this whole process is about. So when we're doing this and you maybe feel like, what on earth is going on? What are we doing? Just bear in mind that everything leads back to inventory, right? We're trying to get to an ending inventory number. And also, in addition to these methods being used for interim financials, the other reason that they may also be used, which is obviously a little bit more unusual, but can happen, is if there is a destruction of inventory for some reason, the estimation technique can be used to come up with a number for ending inventory to be able to make an insurance claim. When we had Hurricane Ida coming through here in New York and New Jersey and elsewhere, I was struck by a news story where there was this medical supply company that was like trying to help people in, significant ways around COVID and so on. And their entire inventory was like underwater from Ida. And so, that's catastrophic, obviously. And almost it seemed like nothing could be saved because a lot of these things are electrical and so on. But if they, in a situation like that, you may not have like up-to-date numbers on what was in ending inventory because you didn't exactly just do an inventory count before the hurricane came. So you may have to use like a gross profit method approach to be able to estimate for the insurance approximately how much inventory was lost. Obviously, there are other options, like they can go back to all the invoices if they have them electronically and add everything up. But, that might take a while. And then you also have to be sure that you're not including things that were sold in the ending inventory. So, just think about it. These are the things that business owners and you as either the accountant or the auditor or whatever that you need to be thinking about when quote unquote disaster strikes, right? So the gross profit method, also known as the gross margin method, if you run into this in some other text or whatever, and it says gross margin method, it's the same thing. You're trying to determine the cost of inventory that has been lost or stolen, or you're testing inventory as an auditor, or you're estimating inventory for interim reports, or you're using it for budgeting, right? Those were the things that we just spoke about. We didn't speak about budgeting as much, but that's also an option for using gross profit method. And then, like I said, it's relying on this relationship, which comes up a lot, right? The beginning inventory plus the purchases, the net purchases, meaning purchases minus any purchase returns, minus any purchase discounts. So just the purchases that are left, the number that we're actually working with is cost of goods available for sale. That's right. Less cost of goods sold is giving you your ending inventory, right? So it's assuming this relationship between the inventory that is there at the beginning, the inventory that's purchased and the inventory that is sold, in order to give us an ending inventory. Anything that it was not sold must be left over. So that's a little bit of a fantastical assumption, because obviously inventory could grow legs and walk out the door, right? Because people steal, or inventory could have been destroyed somewhere, but we're just ignoring that. We're just saying anything that wasn't sold is assumed to have been left behind in ending inventory. And we also assume that we can get to a cost of goods sold number from sales, right? That there's a way that that we can calculate cost of goods sold if we have a sales number available to us. And then I told you a little bit about these markups and formulas. They're kind of obvious. Obviously, 100, if sales is 100% and the cost of goods sold is 60%, then the gross profit must be 40%. So we're relying on this relationship between the two, but you have to remember that the gross profit can be expressed either as a percentage of sales, or it can be expressed as a percentage of cost. So you can't always just say that, oh, a gross profit is 40%, so it must mean, that cost is 60%, because this gross profit over here, the 40%, is being expressed as a percentage of sales. Why I know that is that sales is 100%, so it's kind of like the base, and then cost and gross profit are making up the 100%. Whereas you can also express the gross profit as a percentage of cost, and then you call it a markup on cost, right? And in this case, a 40% gross profit on sales is equal to 66% markup on cost, and there's a way to do the conversion. But again, it's a little bit messy. So when we continue with these examples, which I will in a minute here, I'll show you. It's not really a shortcut, but I'll just show you a way to think through what the percentage should be, or how you can solve the question without having to memorize formulas like this. All right, so I'm going to go back in for those who maybe reviewed this or remember. We actually got to a point in example 3, right, where we needed to calculate cost of goods sold. So I'm just going to go back to the question, example 3, to refresh your memory. And remember, the examples for this chapter are right under the notes. So Fastbro Corporation's April 30th inventory was destroyed by a fire. So when you read this, you already know, oh, my job is going to be to estimate the April 30 ending inventory, right? January the 1st inventory was 150,000. That's beginning inventory. Purchases for January through April, 500,000. They don't talk about purchase discounts or purchase returns. So you just assume that the 500,000 is what you need to use. Sales revenue for the same period was 700,000. Okay, that's great, but that's not cost of goods sold. So we're not, yet able to calculate ending inventory. Fastbro's normal gross profit percentage is on sales, okay, 35%. So already what I was saying before, that if it's on sales, it means sales is 100%, gross profit is 35%. So the cost of goods sold must be 65% of the selling price, right? And I'll show you how to do the math. So using the gross profit method, estimate Fastbro's April 30th inventory that was destroyed by the fire. All right. So we got up to here on Wednesday last week. We said beginning inventory plus purchases gives you total cost of goods available for sale, 650,000, less cost of goods sold, unknown, equals ending inventory, which we need to get to, right? So the question told us, excuse me, the question told us that sales, if we kind of think back, right? Sales less cost of goods sold. This is how the relationship works, equals gross profit. So we know that the gross profit percentage is 35%. The gross profit is on sales, so sales is 100%. And then remember, this is less. So, it's like we're doing a subtraction here. So how do we get from 100 to 35? We obviously have to subtract 65%. Okay, so this is the same as those formulas that you're welcome to memorize them if that makes more sense to you. But I'm actually, when we do these questions, I'm actually just going to show how I calculate the cost of goods sold by working with the percentages in the relationship that we know from from previous accounting classes. All right, so now we know that we have the 100%, which is the 700,000, right? So the question is what is the, what is 65% of 700,000? That's really what, so to get from sales, right, to cost of goods sold, which is what we want, we're going to say 700,000 multiplied by 65%, right? 65%, or it's 700,000 multiplied by 65 over 100. Remember this, you're saying 700,000 is 100%. So if 700,000 is 100%, how much is 65% of that? And so over here, I'm just saying 700,000 times 65%, simple as that. That's the number for cost of goods sold. So that helps me to get to the answer that I'm actually looking for, which is ending inventory. So my cost of goods sold is 455,000. That's subtracted from the total cost of goods available for sale is giving me an ending inventory of 195,000. Questions, anybody? Anything I need to repeat? Or in the next example, I'll do, well, I'm just gonna make up another scenario where the 35% is on cost instead of on sales and show you how you would calculate it, but ask anything that isn't making sense. I'm not seeing any questions here. No one's raising their hand, so I'm assuming you guys are fine, or you're distracted or whatever. Hopefully that's not the case. Hopefully you're fine. So now this is not written into that question, but I'm going to write it here so that we can test to see if we understand how these percentages work, right? Because we want to make sure that we don't get caught off guard by the percentages. Assume all the same facts in example 3 above, except that phosphorus normal gross profit markup is 35%. Oh, sorry, is 35% on cost. So I'm capitalizing that because I want you to remember that this is different, right, from what we did before. So it's on cost. So now the question becomes, does it change beginning inventory? No. Does it change purchases? No. The only thing that's potentially going to change is the cost of goods sold number, right? So we still go through the motions. This is how you can easily keep track of these questions and solve them. Beginning inventory is still 150,000. You're still adding the purchases or the net purchases. They just call it purchases in the question, so I'll do the same to still get to your 650,000, which is the cost of goods available for sale, right? Now you have to subtract cost of goods sold, and again, same thing, you still don't know what that number is, and you're trying to get to ending inventory. So we revert back again to this relationship of sales, cost of goods sold, and gross profit. So I'm saying sales less cost of goods sold equals gross profit, right? We know that the gross profit markup is being expressed as a percentage of cost. So here's the difference. Cost is now expressed as 100% because the item, either sales or cost of goods sold, that is the basis for the markup. In other words, the sales or cost of goods sold, the item that the markup or the gross profit percentage is based on will always be 100%. It's the starting point, right? And from that starting point, you're adding something to get to the selling price. In this case, cost of goods sold is the starting point because it said that the 35% is on cost. All right. So we still know that this is a subtraction over here. So we do that. We also know that 35% is still the gross profit or gross markup. I wrote gross profit is just easier, but when it's on cost, it's really referred to as a markup. It stays 35%. You're just changing which item it's on. Look here, right? It's still 35%, but over here it was on sales, so sales was 100%. Over here it's on cost, so cost is 100%. So to get from you're saying something minus 100 is 35. So it's obviously 135% minus 100 is 35. So sales is more than 100%, which makes sense because sales is obviously going to be higher than cost. So cost 100 plus 35 gives you the selling price. In this case, where the gross profit was on sales, it was cost 65 plus the 35 gives you the sales price of 100%. So that's the way and it's the same as what the formulas are doing. The formulas just look a little bit creepy sometimes. So, you may not always be able to remember them, or maybe you will. You can use either way. If you want to memorize the formulas, it's fine. So again, because the markup is expressed as a percentage of cost is 100%. All right. And so now we ask the question, how do we get, it's still the same sales number of 700,000, right? So how do we get from sales to cost of goods sold? Because we're trying to get to cost of goods sold. So it's 700,000, which represents 135%. You want to go from 135% to 100%, right? So the number that you want is what you put on top. I want to know what 100 is, and I already know what 135 is, right? That's or you can divide by 1.35. It's going to be the same math. Either way, you're going to get there. So now we go up here and populate this. So 700,000 divided by 1.35. So you've got this crazy number here. Let's make sure that we can see what it actually is. So 518519. So see how the cost of goods sold number is actually completely different when we are basing the profit, right, on cost of goods sold and not on sales. So you can't just read 35% and start running and answering the question. You need to know 35% on what? On sales or on cost of goods sold? When the 35% is on sales, the cost of goods sold number is actually lower, right? So now we subtract our cost of goods sold from our total cost of goods available for sale, and that 131,481 is our ending inventory at April 30th if the gross profit or gross markup had been expressed as a percentage of cost. Question, anybody? All right, so you guys think of questions. Maybe what we'll do here now is take 10 minutes for a break. We can come back 11:37. Okay, 11:37. And when we come back, I'm gonna give you guys. When we come back, I'm gonna give you guys a question on gross profit method to do for yourselves. Okay, to see if you understand it. So I'll pause the recording here, and anybody who has questions for me during the break, I'm still here. Right. So we're back from break, and I think that a good thing to do now would be for you guys to test your own understanding of the gross profit method by actually completing this number 8 over here. And I'll read through it with you, and then you'll have some time to do the questions, and then I'll take a volunteer to walk us through the solution. So again, this is gross profit method. Blue Steel Corporation's July 31 inventory was destroyed by fire. You see the rhythm of the question is the same as what we did in number 3. January 1 inventory was 600,000. That's beginning inventory. Purchases for January through July, July being the date of, the time when the fire happened, totaled 800,000. So that's all the purchases that you add to beginning inventory to get to total cost of goods available for sale. Sales revenue for the period was 1.5 million. So remember, you're obviously not being given the cost of goods sold number, but you're supposed to be getting that to be able to calculate ending inventory. Blue Steel's normal gross profit percentage is 25% on sales. All right, so if you follow that approach that I showed you guys, you can see now that the sales is the basis for the profit, gross profit percentage. So sales will be 100% as we called it, and then we work from there. So in part A, they're saying using the gross profit method, estimate Blue Steel's July 31 inventory that was destroyed by the fire. So using this information, and then in B, they're saying again using the gross profit method, estimate the inventory that was destroyed by the fire, but now you're making a different assumption, right? That the gross profit percentage is 25% on cost. So it's basically mirroring what I just did with you guys in the previous example. So it's I'll give you until 11:50 to do both A and B. So it's like 5 minutes each. Probably too much time, but it's fine. 11:50. And at that point, I'll take a volunteer to walk us through the solution. Let me know if you need to see the previous calculations or anything, but for now, I'm going to leave it on the question so that everybody has access to the question. Dora, thanks. I see your hand. I'll take you at 11:50 to go through the solution, okay? All right, we've reached time on this example. So I have Antora who is volunteering, or I hope that's what your hand means, Antora, that you're volunteering to answer this question, right?
Yeah.
Okay, okay, so I'm gonna get to my page and you will walk me through what you want me to do for part A and part B of this question. Go ahead.
Well, 5A, I just put beginning inventory is a 600,000 and add purchase 800,000. So we got 140,000.
You mean 1.4 million, right? 1,400,000.
Yeah.
Sorry, I was in the wrong place when I was trying to put that line. Yeah, so we add these together. This is, you're correct. So this is the total cost of goods available for sale is, I'll just write it in here so people remember total cost of goods available for sale. What's next, Antora?
Yeah. So list cost of goods sold. We got cost of goods sold 75%. Sales 100% and gross profit 25%,
Okay.
and then we got cost of goods sold 70%, 75%.
Thank you. So we were told in the question, you know, I know everyone's already done this, so you're probably like, do we really have to go through all the steps? But I'm just putting it there for the people who got lost somewhere along the line. You're absolutely right. Gross profit is 25%. That was expressed as a percentage of sales. So sales are 100%, which must then mean that cost of goods sold is 75% of sales. So this number over here, we're taking the 1,500,000, right, of, well, I didn't need to put a bracket here, sorry. We're taking the 1,500,000 of sales, to your point, Antora, and we're multiplying it by 75%, or we're saying 1,500,000 multiplied by, this comes out to the same thing, right? 75 over 100. Perfect. So that's gonna
11,025,000.
yeah, 1,125,000. Yes. Hang on. So
So less we got ending inventory 275,000.
okay, so we subtract our cost of goods sold from total cost of goods available for sale to see what is left, and that's 275,000. Perfect. That's correct. So that's the answer that we are looking for, 275,000. If anybody's still confused about what we're doing, we were asked to calculate the ending inventory that was destroyed by the fire. So if this was like a multiple choice or something, you know, 275,000 is the answer that you need to be focusing on. That's, I know this is the bigger calculation, but this is the answer. And Tora, would you like to do part B as well?
Yes.
Okay.
So part B, we got beginning inventory
Same
600,000,
Mhm.
at purchase 800,000, and got 14
1.4
million,
million. Yeah.
1.4 million.
Yeah.
Then
Okay.
we less cost of goods sold. So here have some working sales. Cost of goods sold is 100%. Gross profit is 25%. Then we got sale is 125%.
Right. So yeah, the gross profit is expressed as a percentage of cost. So cost becomes 100. That's the basis of the calculation, which must then mean that sales is 125. If sales less cost of goods sold equals gross profit. Correct. And so we use that, you're saying we use that same information to go and calculate our cost of goods sold, right?
Yep. So
1
1
million.
point
Times, so yeah, you can say times 100 over 125.
divided by 125.
Yep.
We
Either one of
got
these.
100. Yeah, we got 1,200,000.
Yeah, 1,200,000. Yep.
And ending inventory is 200,000.
Yep. That's that. Correct. Thank you. Questions, people, on Antora's, you're auditing Antora's work, you're comparing it to your own work. Do you have questions, comments, places where you got stuck, or are you guys now gross profit method aficionados, right? If I wake you up in your sleep tonight, will you be able to tell me how to do gross profit method? No, I won't be in your nightmares. Don't worry. Okay, I don't see any questions. I don't hear anything other than Antora. I'm speaking into, you know, a black hole. So I'm assuming that everybody's fine. So that was gross profit method, not too bad. Just remember to keep your wits about you when it comes to the expression of the gross profit percentage, right? Is the percentage of sales, is the percentage of cost. Because if you get it wrong, the whole answer's wrong. And in a test, the bulk of the points are going to be around getting the crux of getting the the maximum points is getting this number correct. Even though ending inventory is the answer that you're looking for, the cost of goods sold number, the calculation is really what is driving the ending inventory number. All right, so I'll leave this be here for like 30 seconds, just in case people are taking notes. Remember, you do also have access to this Google Doc on Blackboard under the Zoom materials tab. So all my calculations are live, and you can go in and click on that link at any time and you'll see everything. And you guys are only viewers, so you can't change my answers or anything, but you can click in to see how, how the numbers are calculated. I do have everybody's attendance, but I just want to check, is Jelari, are you here? I haven't seen you today. Jelari Rollins? Okay, no, fine. Everybody else I know is here. Okay, so I'm gonna move on to the retail inventory method. And we can discuss that a little bit. Remember, that's the second type of inventory estimation technique. So you're successful now with gross profit method. So let's hope we can be as successful here with retail inventory method. So I'm back to the notes. And again, all these things are on the Zoom tab, right? It was chapter 8. We're in chapter 9. Everything that you need for chapter 9 is right here. Okay. So the retail inventory method is the second type of estimation technique that we'll look at. Yeah, you're also trying to calculate ending inventory, but you're also looking at the relationship between the selling price and cost and the cost of the inventory, but you're doing it in a little bit of a different way, in that you calculate, basically you end up calculating what's the ending inventory at the selling price for the company, and then you use what we call the cost to retail ratio, or cost to retail percentage, to convert the ending inventory at retail meaning the selling price. Okay, when I'm saying retail in this context, I mean selling price. So the ending inventory at the selling price is converted to ending inventory at cost using the cost to retail ratio, which we will learn how to calculate. Why do this? The sales prices of all these things are readily available to the company. It's actually somewhat easier to some extent, I think, for them to see what those numbers are. So they just calculate ending inventory at selling price and then convert it. Obviously, it should be obvious to us all by now that ending inventory cannot go into the balance sheet at the selling price. It has to go in at cost, right? So, some of the pitfalls when we do this calculation is that people will calculate the whole thing and calculate ending inventory at selling price and forget to convert it to cost. So just remember, we have a few steps here that we need to deal with. So let me just read through some of the theory here to make sure that we're all situated as to how this works. So it's an inventory estimation technique that's been said before. It's based on the fact that there's a relationship between cost and sales price that is, in existence in any kind of selling environment, right? That there's a formula that you're using. You're saying, cost is 50% of selling price, or cost is 66% of selling price, or whatever. So there's this formula that can be used, and so that's what it's similar to gross profit method, but not quite the same, because gross profit method doesn't use only the sales numbers. It focuses mainly on cost. Retail inventory method is very common. That's true. In fact, I believe in your textbook, one of the opening, well, maybe not opening, but one of the little examples is talking about a company. I don't know if it was a Dollar General, maybe, that also used retail inventory method. So it's very common. It's because you don't have to do a physical count of the ending inventory. You can estimate the ending inventory. And so that helps with saving time and energy, money, and so on. but you do need to have good records. I mean, as with any estimation, if your records are shambles, you won't be able to estimate anything, because you know that you're not basing your estimation on good data. So we do need to have the total cost and retail value of goods purchased. So the total cost and the total sales price of all the goods that have been purchased, total cost and sales price of everything that's available for sale, and also all the sales for the period. That information is needed in order to do this. Obviously, in a question, you'll be given that information. In practice, you would have to go find it. And so what's the method here? That the retail value, meaning the selling price of all the goods available for sale, minus all the sales for the period, gives you the estimated ending inventory at retail. That's, so remember I said with this method, you're basically using selling prices to get to ending inventory at sales price, and then using that percentage to convert it to ending inventory at cost. And so you then calculate the cost to retail percentage, or ratio, it's sometimes called, for all the goods, right? So the total goods available for sale at cost divided by the total goods available for sale at retail price will give you what percentage is cost of selling price, right? That's what we're trying to calculate here. And then you apply that percentage, you multiply the cost to retail percentage to the ending inventory that is still at the selling price or retail. Again, retail and selling price are synonymous. You can use it in the same way that you're using gross profit method. This method is somewhat preferable because it's a little bit more accurate than gross profit method, because it's based on the current prices. You know, when we were saying for gross profit method, gross profit is 25% on sales. That's basically on average, that's what the company uses, but we don't know necessarily for everything that is right, you know, that is being sold at this minute, if that percentage still holds. Whereas with the retail, excuse me, inventory method, we're calculating the percentage based on current numbers. So it's really a more up-to-date percentage than the historical gross profit ratio. And so that's also why you know, the FASB that does generally accepted accounting principles, right? I showed you the codification the other day. They actually allow the retail inventory method for financial reporting, even I think on an annual basis. You will still, I think you will still have to count inventory, but you can use this methodology. Another, I mean, as part of your process. And then also because of the way in which the retail inventory method is calculated, you can actually incorporate, you know, FIFO or LIFO average cost into the technique, because you're using cost numbers along with retail numbers. So if you're doing your cost flow assumptions and so on, you're actually able to do FIFO, LIFO average cost. For what we'll be doing, we're not going to go through a whole recalculation of FIFO, LIFO and average cost. The method for the retail inventory method that we will focus on is called the conventional retail method, which is basically using average cost and carrying the inventory at the lower of cost or market. So we really will just be focusing on average cost here. And if, you know, in the textbook, you may see LIFO retail method or so on. That's outside of the scope of our work right now. Okay, so what else do we need to be thinking about? As with any new approach, there might be some vocabulary, some words and things that we need to make sure we understand the meaning. There's this notion of additional markups and additional markups, and also markdowns and markup cancellations and markdown cancellations. It all sounds very involved, but basically what is happening here is because we are working with retail numbers, so selling prices, when we do our calculation, we have to take into consideration whether the company increased the price, the selling price of something even above the regular ratio that they use to mark up the price, or if they marked it down because there was a sale. All those things need to be taken into consideration because you're using a cost to retail ratio. So that's a little bit hard to understand maybe in the abstract. I'll read this sentence and then I'll show you this example that might help you to understand what markups and markdowns are, and we can maybe just also talk about what's happening in real life now with markups and markdowns. When applying the retail inventory method, net markups and net markdowns, so the net markup is any additional markup minus a markup cancellation. The net markdown is markdowns minus markdown cancellations, must be included in the determination of the ending inventory at retail. So they're saying any adjustment that you may have made to the selling price of these items, whether it was to push the price even higher because there was such demand for this thing, or to push the price lower because there just wasn't demand, has to be factored into your ending inventory at retail, because it's impacting, right, the amount of money that you can get for these items. And since we're trying to calculate ending inventory, which is an asset which represents future benefits that we're going to get, we have to factor in, if we can get more benefits than we thought or less benefits than we thought. Okay, so that's why markups and markdowns have to come in. I'll go to this example in a second with Father's Day shirts, but if you think about what's happening in life right now, like I've brought this up before, but it's a pretty serious and pervasive issue, this notion that there's a lack of semiconductor chips in the world right now, which impacts something like cars, right? Cars manufacturers are not able to manufacture cars at the rate that they usually would because they don't have the computer chips that they need to put into the cars in order to make them go, right? All the cars are now so sophisticated that most of them have computer chips. And so now you find that on the second-hand car market, that the prices maybe, a Toyota Camry used to be selling, I'm just making up prices, so please don't, tell me that I'm way off. I probably am, but let's just say a current, like a 2019 Toyota Camry would have sold, for $20,000. But now, because of the shortage of cars and everybody's looking for cars and it's a pandemic and people may have moved out of the city and they really need transport, blah, blah, blah. Now, suddenly a car that would have been at retail for $20,000 is being marked up to $30,000 or $35,000. I mean, the prices have gone like astronomical. So maybe the car dealership will mark it up to $35,000 and see if anybody is going to buy it because people are so desperate. So the $15,000 extra that they're charging, that is an additional markup on top of the selling price that they already had. And then maybe the car dealership said, okay, at $35,000, we're not really getting a lot of people trying to buy this car. So we'll bring the price down to $30,000. So that $5,000 that they take off now is a markup cancellation. All right. So when you think about markups and markdowns, they're talking about markup and markdown on the selling price, not on the cost, on the selling price. So that's one example of how a markup could work. And a markdown would be the same, right? You've got a car that's easier to understand because it's almost like a sale, right? So you've got a car sitting on the lot at $20,000. No one wants to buy it. So maybe you mark it down by $8,000 to $12,000. So that's a markdown. And then you realize that you mark it down by too much, maybe because you're going to make a loss on it. So you cancel part of the markdown. And maybe you say, okay, I had it at 12,000, but that's really extreme. So I'm going to put it back up to 15,000, right? So that's the markdown and the markdown cancellation. A lot of words and things, but we're trying to make sure that when we're calculating ending inventory at retail, that we have adjusted for any and all changes that were made to the selling price, right? Otherwise, our numbers are not going to be accurate. And any markdowns in any case show you that the market is, not as conducive to selling the thing, that maybe there isn't as much demand for it. So that also factors into your thinking around lower of cost or market. So the DC store purchased 100 dress shirts from a vendor. Okay, so shirts, the cost of these shirts was $1,500. So 100 shirts for $1,500, it must be that it was $15 a shirt. DC store's selling price for these shirts is $30 each. So they doubled the price. So their selling price is $30. These shirts were selling really quickly in anticipation of Father's Day. So the manager added a markup of $5 per shirt, which now means that the new selling price of the shirts is $35, right? And the $5 is the markup. This markup made the price too high for customers. So people are like, no, I'm not buying this. And sales slowed, The manager then reduced the price to $32. So they had a $5 markup, and then they canceled $3 of that $5 markup to leave them with only a $2 markup. So that shows you again the markup and the markup cancellation. Right after Father's Day, the manager marked down the remaining shirts to $23. So he took off the extra $2 from the markup that he had to get down to $30, which was the original selling price. And then on top of that, he said, mark it down by another $7. So this is a markdown, right? The $7 is whatever you are doing below the selling price. And then the manager discovered that this price is probably too low now. So they put it back up to 24, which means they canceled $1 of the markdown. So the net markdown is $6, right? Net markdown is $6. Over here, the net markup is $2. So that's the thinking behind it. We'll see in a minute how this is presented. In most of the questions, they give you the number for net markup and net markdown, and you have to know where to slot that into the calculation. But in the event that they give you markups and markup cancellations, or markdown and markdown cancellation, you need to know that you have to net them. You have to subtract one from the other. And so here we are just talking again about how this retail method that we are using, the cost to retail percentage is going to be based on weighted averages of the costs of all the items and their retail prices. And this is already baked into the questions, because you're getting the cost to retail percentage by dividing the total cost of goods available for sale by the total goods available for sale at retail. So that becomes an average cost almost automatically. And then we apply that percentage to ending inventory at retail to get to ending inventory that becomes average cost, because we're using this average over here to get to the cost to retail percentage. And this is what I said is I'm saying all of this because you might get confused, especially when you're looking in the textbook, and I can show you where this is in the textbook, that you need to focus on the conventional retail method. Okay, there are other methods discussed, but our work is focusing on the conventional retail method, which is the average cost approach that I just discussed. But we're also looking at the lower of average cost or market, and that is, I'll show you in the calculation. We get to that by excluding markdowns from the calculation of the cost to retail percentage. Again, we're speaking in the abstract, so it may not make as much sense, but I will show you how taking the whole markdown in the period in which we are is actually approximating the lower of cost or market. All right, so a lot of talking, enough talking. Let's look at an example 4, and see how this, sorry, I've gone too far, and see how this plays out, right? These questions are, a little bit simpler than their explanation, but they're not easy to answer if you don't understand the theory behind them. So example 4 for our retail inventory method. Boyne Inc. had beginning inventory of $12,000 at cost, okay? $12,000 at cost, and $20,000 at retail. Now notice how this is completely different from the gross profit method that just tells you the beginning inventory was 150 and the assumption here is that it's at cost, and that's an appropriate assumption. In the retail inventory method, you're being given numbers that are at cost and at retail, because you have to kind of keep track of both to be able to do the calculation of the cost to retail percentage. Net purchases, so purchases minus any returns minus any discounts, were 120,000 at cost and 170,000 at retail. Again, you're given both numbers. Net markups, so this is going back to what we were discussing just a minute ago. Markups meaning they wrote they added an extra profit on top of the original selling price, right? So the markups minus any markup cancellation, so the amount by which they increased the retail price during this period was $10,000. And then the markdowns, which is the amount by which they decreased the selling price. So we're talking about when they put stuff on sale, right, they reduced the price, was 7,000. And sales revenue was 147,000. Compute ending inventory at cost, right? So this is important because, again, like I said, this thing is so involved that sometimes people calculate ending inventory at retail and forget that you need to change it over to cost, because that's what's shown on the balance sheet. Using the conventional retail method, which was what I just discussed before, the conventional retail method is based on the average cost of the inventory and using the lower of average cost or market. So I'll show you how to do number 4 now, and this approach to doing the question is fairly similar to what is being shown in your textbook. So let me go in here and do example 4 with you. So the way we'll structure this is we'll have 2 columns. The one is for the cost number and the other one is for the retail number, all right? And then we'll do, similar to before, we start with beginning inventory, we add the purchases, but then we also have these markups and markdowns that we need to deal with. So I'll just show you how we work it. So the beginning inventory per the question, and remember these questions are available on Blackboard. I don't know, flip them there. But the beginning inventory is 12,000 at cost and 20,000 at retail. So I'm going to put that in. And again, if you're wondering why we have to keep track of everything, remember we're calculating ending inventory at retail first, but we also need to calculate the cost to retail ratio. Then we've got the net purchases. So the question tells us that purchases are 120 at cost and 170 at retail. So we're literally copying numbers right from the question at this point. And now the net markup is adding on to retail, right? It's adding on to the selling price of things. So we have to include the markup. We don't include it under cost because it doesn't apply to cost, it applies to retail. So here we had said that there was a net markup of 10,000. That markup is added onto the selling price of all the stuff. Someone is looking for me. Yes, cost is 132,000. So the net markup of 10,000 has to be included in the retail number. So now you should be saying, but what about the markdown, right? In this question, there was a markdown. So what's happening with that, the 7,000? We do not include the markdown as a subtraction to get to the ratio. What we do is we actually subtract the markdown further down and take the whole amount out of our retail calculation, because we're going to treat that as a loss in the period in which it happened, which makes sense because it's the same as calculating lower of cost or market. So we're not putting markdowns here, because once I draw this line over here, these are the numbers that we will use for the cost to retail ratio. And again, the markdown does not factor into the ratio. The markdown is subtracted as a separate number later on in the calculation. So we add these two together, and as was said in the chat, cost is 132,000. I don't know why this thing. Let's see. Okay, I'm not gonna fight with this thing. That's not gonna be 105, 106, and oh boy. Okay, and so it's not feeling me today. 107. So 200,000 and 132,000. So we're saying when cost is 132,000, the potential, right, to that can be sold, total cost of goods available for sale, total cost of goods or total retail goods available for sale, 200,000 and 132,000 respectively. And this is what we use for the percentage. So on the side over here, we could say cost to retail percentage. It should probably be hyphenated, but it's fine. So I'm taking 132,000, right, as the numerator, and I'm taking 200,000 as the denominator because I want to know what percentage is my cost, right, of my retail or selling price. So 132 over 200,000, 66%. So now the question is, what does that mean, right? This means that cost is, based on these numbers, right? Cost is generally 66% of retail or selling price, right? And let me get rid of this thing of retail or selling price. And so ending inventory, which is the number we're trying to calculate, ending inventory at cost, should be 66% of ending inventory at retail. And remember, the aim of this whole thing is to calculate ending inventory at cost. So now we have this information and we can move on. Remember, with all of these calculations, it's like you already know that this is like the total cost of goods, right? Or total retail amount of goods. So everything that's available to be sold minus what was actually sold is going to give you what is left. We don't have a cost of goods sold number. So this is where the calculations on this side of the process will end for now. And we're going to move on. Now is where we subtract, now is where we subtract the net markdowns, because we're saying this is lost to us. Okay, we're not just going to try and subtract it and come up with a percentage. It's completely lost to us. We lost the money in this, even though we have not necessarily maybe sold all of the things that were marked down. We should treat, based on what we learned right at the beginning of the chapter, we should treat any markdowns as a loss in the period in which they happen. So we subtract the markdowns, and then we also subtract the sales that we have for the period. Sorry, someone, I didn't realize I was trying to say something. Okay, yeah, thank you. Retail was 200,000. So the sales for the period, 147,000, right? That's what we're trying to find. So 147,000 is also being subtracted to get to ending inventory at, and I'll capitalize it so you can remember that this is at retail, which is not our final answer, but is, and in fact, I should, yeah, it's fine. I'll leave it like this. So how do we get there? We're going to say the total inventory at retail minus the markdowns, amounts we will never earn because we marked our stuff down, minus everything that was sold, is going to give you your ending inventory at retail. So it's 46,000, right? So it's the 200K minus the 7K minus the 147. That's how I got to 46,000. So that's at retail. Now I want to get to ending inventory at cost. And yeah, I'm going to just say, obviously, 46,000 multiplied by that percentage that I came up with, 66%. So my ending inventory at cost is 30,360. How did I get there? I said 46,000 multiplied by the cost to retail ratio of 66%. This is the answer. This is, and in fact, let me just capitalize this so that people can remember. This is the number that goes into the balance sheet. Okay, that's the number that we're looking for, not 46,000. Questions, anybody?
I have a question.
Yeah, go ahead.
Why we subtract sales?
Yeah, because what you're trying to do is see how much is left of inventory is left at the selling price. So if you started with all the inventory that you had at the beginning at selling price, you're adding to that all the inventory that you purchased, right, at selling and at their selling price. Add to that all the markups, the increases in prices. That meant that at some point you had $200,000 of inventory available to be sold, right, at retail, at selling price. From that, you're saying you marked down some of the stuff, so you're never going to get that money. So you need to subtract the 7,000. And then the 147,000 is what was actually sold. So that cannot be part of ending inventory, right? Because it was already sold to your customers. So your ending inventory is always the beginning inventory plus the purchases minus the sales is ending inventory. So we're following the same approach. It's just that we're using the approach on selling price instead of cost. That's why sales is being subtracted, not cost of goods sold.
Thank you.
All right. Thanks for asking that, because maybe someone else is thinking, hey, when we were doing gross profit method, we were deducting cost of goods sold. Now we're suddenly deducting sales. What happened? Are you making a mistake? Is everything going crazy? No, we're just simply working with sales prices. And at the end, we're converting them to cost. Other questions? All right. So let me see what, I know there's an example that you guys can use, so, or not use, do, which I'm sure you're super excited about, right? Yeah, so number 7 in our on the notes page is a conventional retail method question. I'm going to have you guys do it so you can make sure that you actually know what's happening. I'll read it with you, and then you can go ahead and do it, and then I'll take someone, a different person who hasn't spoken yet today to walk us through the solution. So for 7, Hulk Inc. had beginning inventory of 62,400 at cost and 105,100 at retail. So you see how the rhythm of the question is the same, right? They're giving you the two numbers. Net purchases 132,500 at cost and 225,100 at retail. Net markups were 20,500. So they marked the selling price up even higher by 20,500. And net markdowns, these were the losses that they are, planning to take, but they have to be taken in this period, of 33,000. Sales revenue was 191,000. Compute ending inventory at cost using the conventional retail method. So if people want to take a picture of the question, I can flip back to the previous solution if you didn't take it down. Whatever you want to do, I'll give you a minute to either write down the question or take a picture of it, and then I'll put the screen back on the previous solution to just give you guidance on how to do the question. And then we'll take 5 minutes to answer this question. So we'll go until 12:35 to answer the question, and then someone will walk me through that answer. Okay, 12:30, I'm switching over to the solution. So if you still need to take a picture of the question or write it down, okay, your time is up. So that's the previous solution. You're following that format for 5 minutes, answering question number 7. I see your hand, and so I'm trying to take someone who hasn't spoken yet today. So we'll see if someone else volunteers, then I'll take them. Otherwise, I'll take you. Okay. But I'm welcoming other people to volunteer to give the solution as well.
Professor, could you open the problem, please?
You need to see the question.
Yes, please.
Oh, okay. I'll go there for like 5 seconds because I think people need the solution as well. Is that good? Gian?
Yeah, thank you.
Okay. All right, so do I have another volunteer to answer this question? A hand. It's okay if you're not 100% sure that your answer is right. All right, so we are lacking, I'm sure it's because it's like the last 10 minutes, we're lacking in volunteers and Tora, so you have the floor. If you still want to answer this, otherwise I can answer it. All right, what do you want to tell me?
So our beginning inventory for the cost 62,400,
Mm-hmm,
and for the retail is 105,100.
mm-hmm,
We have a need purchase. We're gonna add 132,500,
mm-hmm,
and for the retail one 225,100.
Now what?
We have a now need to make up. We're gonna add this one. On the retail column is 20,500.
Hang on. What, are we together? Oh, sorry, I missed
We have
the
a need
mark,
to make
sorry,
markup.
I jumped the gun, sorry. I'm losing it. The the markup, thank you.
Yeah, on the retail
Yeah,
column is
20, yeah, you
20.
said 20,500 and I was just on my own mission here. So, thank you. So now we can total it, right? Okay,
For the
good,
cost, we have a 194,900,
that's correct.
and retail 350,700.
Perfect. What's next?
We're gonna need to make markdown on the retail column 33,000.
Less, right? Let me put less.
Yeah.
Mm-hmm. So we're deducting 33,000. Perfect. What
And
else?
less sales 191,000.
Yes. And you know now why we have to subtract the sales, right?
We have a
Okay.
ending inventory at retail 126,700.
So you're taking the 350, you're subtracting 33, you're subtracting 191. Do you have the same number? 126,700. Yes. Are we done?
Yeah. No, we have a sum working here. So cost to retail percentage,
Okay.
we 194,900 divided by 350,700. We
Okay.
got 55.57%.
So it's gonna be the 194 over the 350. So notice which numbers we use, everybody. It's the kind of the total cost and total retail available number that you're using. And you're saying that divided by that. So it's this weird number, but we put it 55, 57 or thereabouts, right? 55, 58. What did you get? 55, 58?
55.57%.
Oh, 57 also. Okay, fine. And now what do we do, Antora?
We're gonna working on ending inventory at cost 126,700 into 55.57%. So we got here 70,407.19.
So mine's a little bit off because I didn't, let me do this. So I'm the same as you. Let me round it, okay? Because it's getting even less now. Hang on, what did I do on the 55.57? What did you get? 74.19?
Is a 0.19.
Oh, 0.19. Okay, so it's 7, but you have 74.07.
Yeah, that is
okay,
correct,
okay,
and a
okay.
0.19.
Thank you. Sorry, I thought I was.
So we're gonna take round figure, or we
two
can
decimals,
take
two decimals on the rounding, 2 decimals. So you would do it like this, 55.57. And then on the number, you can, it depends on what McGraw-Hill says. If it wants 2 digits, 19. If it just wants the round number, it would be 7407. That you will get given, there's normally written there round to 2 decimals. That's usually I see round to 2 decimals, but you'll see what the instructions are on the question. If we were doing this in class by hand and you were with me, I would say round to 2 decimals on everything, if there's rounding needed. Okay. Great.
Thank you.
That's the answer, 7407. So that's ending inventory at cost. That's the number that we need. Anybody have anything else to add? I know, Jaron, you were giving some commentary in the chat. Thank you. And confirming you were auditing our numbers, right? All right, so that's the deal. I wanted to show you let me give you until I guess another 30 seconds of people taking pictures. Remember, this document is available to you. You're still figuring things out. I'll stay here until 12:42. And then I just want to show, okay, it's 12:42. I want to show you one more thing, and then you are out of here. So I just wanted to show you one of the companies that you could have chosen was Beyond Meat. I think one person chose it, so it's fine. I'm just showing this because it was just something that was in my mind to show you. I literally put in a Google search Beyond Meat Form 10K. This is in relation to the term research paper. If you go, do you see here, this is the investors section of the company. Then you click on there. When we're talking about finding annual reports, I know that all the company stuff doesn't look like this, but I'm giving you one example. Filing year, not sure, but I'm looking for annual filings. I'm looking for annual reports. And over there, you can see is they issued their financials on March the 1st, 2021. This is an annual filing. So I'm going to click on Form 10K, and then that's the annual report. I can choose how I want to view it. I'm going to view it as an HTML, which means I can actually click on the links. This is the December 31, 2020 financials. What I wanted to show you here is when you see almost every company that we have will have this kind of setup, right? You're looking for the financial statements and supplementary data. And remember, management discussion and analysis also comes up in your in the part A. So these are really the things. You can also maybe look at the selected financial data as like a financial highlights, but these are the 6, 7, and 8 specifically for this company is what you're looking for. I wanted to show you that when we're talking about auditing, this report of independent registered public accounting firm, that's the auditor's report. And when I was telling you, you know, why do auditors have to look at the financials? They say it here in their report, right? That they have audited the financial statements, and then this piece, in our opinion, the financial statements present fairly in all material respects the financial position of the company. So this is why they do what they do. They're trying to tell, you know, basically the shareholders that you know, engage them to do the audit, that the financials are fairly presented. In other words, there's nothing sketchy going on. There's some other stuff that they discuss here for this company, and you can see that the auditors for this company are Deloitte and Touche. It happens to be the company that I used to work for. Part of why I chose Beyond Meat, and for those who, I guess, for whoever is doing Beyond Meat, I thought it was an interesting company because if you see their revenue from 2018, when, you know, which is the earliest year shown, was 87, I guess, in thousands, so it was 87 million, and it's gone up to almost half a billion, 406 million. So it's a company that's growing astronomically. I guess people have more of a taste, right, pardon the pun, for plant-based food. So it's just an interesting company to look at. They also listed fairly recently, maybe in 2018, on the stock exchange. All right, so I'm showing you that to just show how to maybe do a simple Google search to find the Form 10K. Make sure you're looking at the latest annual report. If you have problems or questions, you know, please just contact me and I will gladly help you.